You know, when you think about a health checkup, you think about a doctor checking your vitals and giving you a final diagnosis. But what if we could do that for a company? Well, that's exactly what we're going to do today. We're putting a major healthcare company on the examination table to check its financial vitals. Okay, let's dive in.
So here's the big question that really got us curious. Narayana Hrudayalaya, or NH as we'll call it, literally built its entire reputation on making world-class heart surgery affordable for the masses. So how on earth does a company with that mission also become a darling of the stock market? That's the puzzle we're here to solve.
First things first, let's just get a sense of how dominant this company really is. NHC controls a massive 18.5% of the entire cardiac care market in India. I mean, let that sink in. They're not just another hospital group. In their main specialty, they are the undisputed leader.
So, let's go ahead and formally start our checkup by, introducing our patient for today's analysis.
This is Narayana Hrudayalaya. It was founded by the legendary cardiac surgeon Dr. Devi Shetty, and it's one of India's absolute top-tier healthcare providers. The core idea, their whole mission from day one, has been to mix that elite, world-class medical care with a price tag that doesn't break the bank.
So, how do they pull it off? It seems almost contradictory, right? Let's get into the diagnosis and figure out how this business model actually works. What's the secret sauce that lets them have both amazing quality and low costs?
To really get their success, you have to look at what analysts call their competitive moats. These are the deep trenches that protect their business. First up, an incredibly powerful brand built on decades of trust. Then you've got their cost leadership, which comes from just being unbelievably efficient. Their massive scale, we're talking over 6,000 beds, gives them huge purchasing power. And finally, and this is genius, they use a hub and spoke model. All the top-level expertise is in big city hospitals, the hubs, and they deliver care through a network of smaller centers, the spokes. All right, so we've got the patient's history, we understand their DNA, now it's time for the really important part of our checkup. Let's check those financial vital signs. The first vital sign is growth, and boy, is it strong. A 16.8% jump in revenue year over year, that's a fantastic pulse rate. It tells you this is a company that's not just healthy, it's expanding. It's growing fast as more and more patients choose them. Okay, vital sign number 2 is profitability. An EBITDA margin of over 26%. Wow, that signals just incredible operational health. Think of it like this. For every 100 rupees that walk in the door, they are just exceptionally good at turning it into profit. Way better than their competition, in fact. And the third vital sign is financial strength. A great way to think about a company's debt is like its blood pressure. And by slashing its net debt by over a third, that's a 34% drop, NEH has basically lowered its blood pressure. It just makes the whole system tougher, more resilient, and ready for anything. And this chart right here just drives that profitability point home. You can see NH's margin, that tall bar at 26.2%, standing head and shoulders above the average for its peers, which is down at 21.7%. They aren't just doing well, they are leading the entire industry in efficiency. So, the patient's current health is looking excellent. But what about the future, right? Any good checkup has to include a long-term prognosis. So, let's take a look at that now. The company has a really clear 4-pronged plan for the future. First, they're just getting bigger, adding over 1,500 more beds. Second, they're pushing into smaller cities using that hub-and-spoke model that works so well. Third, they're looking internationally, building on the success they've already had in the Cayman Islands. And finally, they're pouring money into technology, like telemedicine. It's a solid, robust plan for more growth. Okay, so we'd established we have a very healthy company with a strong plan to grow. But this is an investment analysis, so we have to ask the big question. What's it actually worth? It's time to get a second opinion on the price tag. And this is the million-dollar question for any investor, isn't it? We know the business is excellent, but is the stock, at its current price, a good value? Or are you paying way too much for all that quality? Now, this is where the story gets really, really interesting. Take a look at the PE ratio. That basically tells you how expensive a stock is. NH's PE is almost identical to its competitors. The market is pricing them about the same. But now look at their profitability, that EBITDA margin we talked about. You're getting a company that is almost 5 full percentage points more profitable for the same price. That's not paying a premium. That's getting a premium business for a standard price. Looking down the road, analysts try to project a future value. According to the report we're looking at, the valuation could be anywhere from around 1,120 rupees in a more cautious scenario to maybe 1,650 in a really optimistic one. And with the stock trading around 1,247 today, that puts it right in the middle of that potential upside.
Okay, we've seen the history, we've checked the vitals, we've looked at the prognosis, and we've talked about the price. Now it's time to see the final report card, the analyst's overall verdict from this whole checkup.
And there it is. The final score is a very, very strong 8.2 out of 10. This points to a really high-quality company with a solid foundation. But the real story is in how we got to that score. Let's break it down. Just look at these scores. Management quality, off the charts. Competitive position, growth, financial health, all fantastic. But then you see the valuation score, a much more modest 6.2. And this perfectly tells the whole story. This is an absolutely exceptional company. But you know what? The market knows it, and that quality is already reflected in its price. So what's the final word from the report? This quote sums it up just perfectly. Basically, even with that premium price tag, the analyst believes that the company's sheer dominance, its efficiency, and its future plans make it a really compelling opportunity for the long haul. And that brings us to our final question for you to think about. The financial checkup is done, the patient is in excellent health, but it definitely comes with a premium price tag. So for an investor looking to add a great healthcare stock to their portfolio, is paying up for that quality the right prescription? That's the question this analysis leaves us with.